What is the outlook for the economy, inflation, interest rates, and investments? Today, we're joined by Peter Boockvar, the Chief Investment Officer of Bleakley Financial Group and the author of the Boock Report, which can be found on Substack. Peter has an extensive amount of experience as a market analyst, portfolio manager. I've been really looking forward to this conversation. I know a lot of the viewers have too. So let me just start out by saying, Peter, welcome to the program.
Thanks, Patrick. Appreciate having me on.
Yeah. What I wanted to do was start out kind of with a general question, and that is many of our viewers are younger, and I generally will talk with them about their investment time horizon. And so the first question that I wanted to ask was, what is your overall assessment of the economy and investing? We could say both short and long term. When I say short term, I'm saying maybe 18 to 24 months, and long term would be longer than 10 years. What, like right now, what's your overall assessment of the market and where people should be, young people should be positioned? Again, we're not giving financial advice, but just your overall assessment.
Well, in the short term, the market's living in a sort of new economic and investing world, and that is one of higher interest rates. We went from the great financial crisis up through 2021, where interest rates were essentially zero, and mortgage rates were 3%, and rates around the world were very low, and in some cases in Europe and Japan were actually negative. And that was an extraordinary moment of time of very easy monetary policy. But the quickest inflation in 40 years drove a more aggressive interest rate change, where we're now in an interest rate regime that was last seen before the financial crisis in 2007. So it's that adjustment that I think we're all still sort of getting used to and having to painfully digest for those that are trying to borrow to buy something, whether it's a household or a business, or if someone has debt coming due. It is a new world, and it's that higher cost of capital that will be a drag on economic activity, and should be also when it comes to the stock market. Now, in these kind of environments, and actually any kind of environment, time horizon is very important to being successful in the markets. Those that have the longest time horizon tend to win the most, because even when you're in difficult or in challenging time periods, like I think we're in right now, having an extended time horizon actually is to your benefit, because it allows you to sort of ignore the noise, work through it, and actually hope for cheaper markets, because it allows you to buy things, or I should say lower markets, because that allows you to buy things cheaper. It's much better to buy things when they're down than chasing them when they go up.
Yeah, absolutely. Speaking of which, you talk about buying cheaper. With this new interest rate environment, what is your outlook long term for the stock market? And to be clear, or a little bit more precise with my question, what is it that you think as far as index funds are concerned? A lot of our viewers are either active military, some of them are government employees, and they're invested in the retirement program, which is called the Thrift Savings Plan. I'm sure you're already familiar with this, but it has, kind of very limited options that you can invest in, with the idea that you want to put your money in low-cost, broad-based stock and bond index funds. Again, not giving financial advice. It's not necessarily what we're doing here for individuals, but in a general sense, over the long term, do you see stock index funds as a good place to put your money, or do you think it's smarter to, have it also in something that's a little bit more focused?
Well, I do think it's good to have money in different places. An index fund definitely should be a key component of that, but I don't think should be the only placeholder of one's investment money. The thing about index funds is they tend to, at moments in time, get concentrated. Like today, 7%, give or take, of the S&P 500 is Apple. It's one stock. If you look at the top 10 stocks of the S&P, it's about 30% of the S&P 500. So buying an index fund of the S&P, again, to use that as an example, you're buying 500 stocks essentially, but it's very concentrated in the top 10. So I think to get better diversification, an index fund should not be the only holding, but a piece of a broader portfolio. Even though it could be a large piece of that pie, it should not be the only slice of that pie.
What are some other areas that you might diversify into that would protect you? I mean, I can think of a few, but I'm just curious what your thoughts are on that. If you're looking long term, out of 10 years, we're trying to keep the time horizon as far off as possible. What are some other areas that you like?
Well, if you're going to invest in stocks, nothing's going to protect you. It's a question of being positioned for gains in sort of a diversified fashion, because there are times when certain areas of the market do well and other areas that do not do well, and it's very hard to figure out when is when. We've had moments during the markets where the headline indexes, after a decade of growth, sort of consolidate for 10, 15, 20 years. We've seen that in the past. I mean, the S&P 500 topped in or I should say the Dow topped in 1929 and didn't get back to that level until 1954. The Dow in 1966 was no different than it was in 1982. Or say 1982 was no different than it was in 1966. I think the key is to, and to really answer your question, it's good to have some small cap stocks in your portfolio. And I still believe that international investing should be a part of your portfolio too. Now, over the past 10, 15 years, the US stock market has dominated global markets because of the heavy influence of technology companies here. But I still think it's good to have some international exposure, particularly in emerging markets. When you think about the world, 8 billion people, the US only has about 330 million of them. And while many US multinationals do business around the world, there's a lot of economic activity that takes place in other markets and other parts of the world. And I think it's good to have some exposure there. But I also want to emphasize too that the stock market is strange in the sense that it's one of those places where people get more excited about buying things the more expensive things get, and the cheaper things get, the more scared people get. Walmart became the biggest employer in the U.S. because they had a very simple slogan. It was called everyday low prices, and everyone rushed to go. If they said everyday high prices today, no one would show up. But when the New York Stock Exchange says everyday high prices, everyone wants to buy as much as they can.
Right.
And so I think it's important that if you're going to invest in the stock market, you have to understand that markets don't just go straight up all the time. And you should treat your portfolio and your desire to buy stocks like you would buy anything else. And that's things that are discounted. If your local car dealer was offering an incentive for you to buy, you'd take advantage of getting that car because it's a bit cheaper. If you're going into a store or a restaurant and there's some things on sale, you're more enticed to go. Well, look at the stock market in that same way. So if the stock market goes down, don't be afraid. Don't panic. Take that as an opportunity to say, hey, if I liked it at these levels, I'm going to really like it at these levels, assuming nothing fundamentally long-term has changed, and take advantage of cheaper prices and don't get sucked into the typical psychology of the market and human nature, where people get scared at the bottom and they get excited at the highs.
Are there any particular sectors, you'd mentioned small caps, having some of that in your, investment portfolio, and international, particularly emerging markets. Are there any particular sectors of small caps or international emerging markets that you see as being undervalued right now?
Well, in the short term, and not necessarily undervalued, but in the short term, looking out over the next year or two, we like and we're long energy stocks, thinking that oil and natural gas prices will continue higher. So that's one area that we like. Also, I'm bullish on precious metals and other areas of the commodity space, like uranium, for example, on a renaissance of nuclear. There are cheap value stocks in the U.S. that don't have AI in its name, and hasn't necessarily benefited from the technology companies that are integrating that uh, in their products. But there are a lot of cheap stocks out there. I think for a lot of the viewers, I don't necessarily know if they're going to want to start picking individual stocks as opposed to uh, buying indexes, like you said, or buying sector specific things. But if anybody's interested in buying individual stocks, I think there's a lot of good choices out there. I think it's important to, whenever you look at an investment, is to figure out the type of industry one is in. I mentioned energy. Energy tends to be very cyclical. Oil prices go up and down, uh, and therefore you, in a way, have to shorten your time horizon as opposed to buying a company where there's many decades of potential growth, where you can ride, a long train with that particular company and and be less sensitive to the vagaries of a cyclical industry. So it's important to sort of differentiate the type of business that you'd be investing in. Is it cyclical or is it non-cyclical?
What is it about commodities? You mentioned energy and precious metals. What is it about those that you are bullish about? Like, what is it about them that you see potential in?
Well, I think the we have this whole energy renewable transition that's going on, and what that means is if you're an oil and gas CEO, you have people in the world that want to put you out of business, and everyone's spending trillions of dollars. When I say everyone, I'm talking about countries and many companies spending trillions of dollars to try to put you out of business, to try to build products like an EV or electricity sources like wind and solar that will need less of you. So that means that you invest less in your business and you focus more on generating cash, paying dividends to your shareholders, and you're not going to make 5, 10, 15-year long-term capital investments with that kind of uncertainty. So that will lead to higher energy prices because there will just be less supply of it. At the same time, the world still needs a lot of energy. The world, I mean, even if you dig for, if you needed to build an EV, you still have to dig for copper and nickel and lithium and cobalt. Well, the trucks that work on those sites that aren't EV trucks, they're diesel driven trucks.
Right.
Oil prices don't, crude oil refined into gasoline is just not used in a car. The clothes that we wear is using petroleum of some sort. Plastics use petroleum of some sort. Petroleum goes into a lot of different things. So it's something that we're going to use for a long time. And wind and solar don't always work in the sense of it. Sometimes the wind doesn't blow where the sun doesn't shine. So we're still going to need natural gas to power electricity. Nuclear is, as I said earlier, is seeing a renaissance because it's the cleanest baseload power ever invented, 24 hours a day, 7 days a week. So that's pretty important as a commodity. But for the last 10 years, we haven't really seen much uranium production post the tsunami in Japan and Fukushima, which shut down all of Japan's nuclear facilities and even got Germany to close all of their nuclear facilities, which ironically means that Germany is now using more coal today than they were 10 years ago.
That's an interesting perspective you have, Peter, because it's like you really are thinking long term, which I think a lot of investors don't. They kind of watch the market, like you said, and they buy when it's high and sell when it's low, unfortunately. But it's like the way you're thinking about this kind of opens a listener's mind to potential. You mentioning energy. Yeah, there's a lot of pressure on energy companies right now. And for that reason, they're probably not making a lot of long-term investments, which will further constrict the supply in the future when demand will probably be higher. So it's a really interesting insight. What do you think of, shifting slightly from equities to bonds to fixed income? What do you think of the safety of the bond market as a hedge, right? So if retail investors or even big investors are essentially investing their money in a way to mitigate their risk and they want to put some money in bonds, do you still see treasuries as a safe haven, with the volatility in rates in the last few years with rates seeming to stay higher now, or do you not see them that way as much anymore?
No, I think fixed income can be an important part of one's portfolio because not everyone has the risk tolerance of just being in all in stocks. Some people just don't have the stomach for the volatility in the market because investing that way is not for everyone. And bonds provide right now a very good alternative or a supplement to an existing equity portfolio. Because for the first time in 15 years, you're getting pretty generous levels of interest rates that you can benefit from. And but it's important to know like which part of the yield curve, call it, in terms of maturities, do you want to go out when you buy a bond? I think treasuries are very attractive, but particularly those that are shorter term in nature in terms of maturity, and where you can buy a 1 year T-bill, for example, and get almost 5.5%, where you can buy a 2 year treasury and get about 5%, which and you can also just buy a CD at your bank, which is probably paying in the fours or fives, which certainly beats the almost microscopic level of savings rates. So I think those that want to have some lower risk money at work, and I call it sleep at night money, where you don't have to worry about the volatility and the emotions of the stock market. Finally, after 15 years, sort of in the interest rate desert, looking for water, aka interest rates, there's finally some generosity on the part of the bond market for people looking for yield.
Do you see potential in the bond market for there to be greater risk in the sense that a lot of people may not be factoring in the long-term inflation risk? It seems that inflation is now not that it's as high as it was last year, but it does seem to be kind of in this sustained, slightly higher level. And do you foresee that potentially being a risk that we need to take into account when buying bonds, even longer term bonds, because their interest rate isn't that much higher than the official inflation rate?
Well, it's important when we talk about bonds. You can buy an individual bond where you have the choice of holding it to maturity or not, versus buying a bond mutual fund or a bond ETF. And there's an important distinction because when you are buying a bond or a bond mutual fund, or buying a bond mutual fund or a bond ETF, you're not only buying a basket of bonds, but you're also essentially placing a bet on interest rates. Because if interest rates go up, the value of those bonds go down and vice versa. Whereas if you're buying a bond, yes, on a daily basis, the value of the bond will go up and down depending on the price of it and where interest rates go. But as long as you hold it to maturity, assuming it's credit good, you're going to get back your principal. So it's important and to understand that you can still lose money in bonds on a mark-to-market basis, and certainly lose money in bonds in a mutual fund. Particularly over the last couple of years, if you had bought long maturity bonds, even treasuries, you're down sharply. If you bought a 30-year treasury in the middle of 2021, you probably have lost maybe 40% of your capital. Now, if you hold it to maturity, you'll get that back, but 27 years left is a long period of time.
Right.
And people may not have that sort of time horizon, but at least right now, the marking of that is down substantially. So bonds are safe if you can hold to maturity, and it's easier to hold something to maturity when you have a shorter maturity. If I own something that's going to mature in 2 years, that's much easier to hold until it matures as opposed to buying a longer term bond.
I know, to follow up on that, I know a lot of people don't necessarily have the time to wait to maturity. If they do, that's great because then they can recover their principal. But I was thinking, if you're waiting a long time and inflation were to affect that, I guess my question would be, how do you foresee maybe future government fiscal and monetary policy affecting bonds, long term? Do you see kind of our leaders' ability to get inflation under control and get us back to not, I want to say ideal scenario, but a post or a pre-COVID setup? Do you see that as being realistic, or do you think we're going to have to deal with inflation at higher levels for longer?
I think higher levels for longer. I mean, inflation certainly is moderating. We
Right.
peaked at, I think, 9.1% in the CPI last summer, and now we're sort of in the threes.
Right.
Maybe we get to the twos by the end of the year, but I think a more sustainable inflation rate for the next couple of years is going to be 3 to 4, rather than the 1 to 2 that we had before COVID. On the fiscal side, which is definitely an influence here, is out of control in the U.S. Uh, I know in the 1980s people talked about exploding budget deficit. Uh, Here we are
I'm
40
I'm
years
old
later.
enough to remember that.
Yeah, here we are 40 years later, but now it really is exploding. Historically, the budget deficit as a percent of GDP in a recession, at the depths of a recession, so that implies tax receipts that are down and a lot of government spending to try to get us out of that recession, usually bottoms out around 5% to 10%. It was in the early 80s recession, in the 1990 recession, even in the 2000 to 2002 recession, bottomed out at about 5%. The great financial crisis bottomed out at about 10%. Here we are, not in a recession, and with an unemployment rate of less than 4%. So a lot of people working and paying taxes, and we have a budget deficit as a percent of GDP for the 12 months into July of 8%. It's an extraordinary number, and it's rather alarming. And you can be sure in the next recession, it's going to be double digits. So what that means is the U.S. Treasury is going to have to sell, and currently is selling, an enormous amount of treasuries, that all this excess supply is not being met by enough demand, and leading to a rise in longer term interest rates. And I do think that this is going to be a continued problem. And all this government spending also creates inflation itself, that I think is going to be prolonged too. So you have the Fed that's trying to contain inflation, and the fiscal side generating more inflation. So it's sort of the federal government is at odds with each other, arms of it, in terms of trying to moderate the level of inflation.
Right. It's not like they're working at cross purposes. If, looking out a few years or several years, if we know this isn't sustainable, how would you see this playing out? Meaning to say, if we actually did hit something of a true, fiscal crisis or monetary crisis, how would you recommend people would be prepared for that? Like, first off, how would you envision that unfolding? Hopefully it doesn't, but it seems like to a certain degree we're past the point of no return. But how would you envision that unfolding, or how would you see that unfolding, and how would you recommend people would be prepared for that for the future?
Well, on the fiscal side, from a lawmaker side, usually they react only during a crisis. And while a crisis is not here, just looking at the books of the government, you're talking about interest payments that are now only accelerating as government debt comes due and needs to be refinanced, to the point where interest expense in this country at the federal government level is approaching $1 trillion. And for perspective, that's well more than what we spend on defense. So we're reaching a point where this is becoming unsustainable. But what would trigger sort of a crisis is if long-term interest rates, because the Fed controls short-term interest rates via the Fed funds rate. So
Right.
that's the overnight rate, and it's tightly tethered to usually maturities out to 2 years. But when you look at 7, 10, and past that at maturity, that's more market driven. And we're possibly seeing the beginning signs of the Fed sort of losing control of longer term interest rates. And some of this has to do with a lot of the supply, as I mentioned. And when this acceleration continues, or if, I think, as it continues, long-term interest rates become such to a point where the government finally says, wow, we can't keep this up because of, look at our interest expense numbers. The other thing to keep our eye on is the value of the US dollar. Because if the value of the US dollar starts to falter, that can be the world's opinion that we want to hold less dollars because this fiscal situation in the US is out of control. Now, in terms of an investor managing and dealing with this, it's not an easy answer, because I'm not going to tell you to hide in a cave with gold bars. Uh,
Right.
that would hold it better than paper money. But I think it's just things to be aware of. Just as a parent tells their kid when they go out, just be aware of your surroundings if they're going into a different place. An investor should always be aware of their investing surroundings and economic surroundings. But the world is always uncertain. The only thing certain is things are uncertain, and they're always going to be challenges and risks and scares and this and that. Uh, but that gets back to the importance of having a time horizon, because a time horizon allows you to get through any bumps in the road and allows you to get to the other side.
Well, Peter, I know we're closing in on our time here, but I wanted to just ask you, what is the best way for viewers to reach you? Like if they wanted to, get financial advice with Bleakley Financial, if they wanted, to follow you, what's the best way to do that?
Well, on the wealth management side, they can go to our website, bleakley.com, and reach out to me, and I can put them in touch with a financial advisor. And in terms of my thoughts, I write daily via the Boock Report, and it is on Substack. It's peterboockvar.substack.com. And I talk about the economy and markets and anything else that's top of mind on a daily basis.
Okay, great. What I will do is I will put those actually in links beneath this video. So, Peter, thank you very much for being present today, for this interview, for helping our viewers to learn a little bit more about the market, maybe some ways that they can adjust their investment strategy. We appreciate your time.
Sure. I appreciate having me on. Thanks so much.
And to the viewers, please remember to subscribe, and thanks for watching.